Good morning, everyone. Let's get started. Let me introduce the folks who will be speaking today. My name is SIlverman. Obviously, I'm the person that's bombarding everyone with all of the invites. If you didn't get one, I'm sure happy to send you another one. I'm joined today by my law partner, Theologou, and together we're here with Seth Behrensweig of the law firm of Behrensweig Leonard, and Kevin Fitzpatrick, Chris Staub, and Jonathan Silverman for the Capital Group. Let's get started. As the first slide indicates, obviously the world's changed a lot in the last 30 days. How we do business, how we interact with our coworkers, how we do everything basically has changed for us. Some of the data points that I put in there talk about, unfortunately, unemployment, how many folks have applied for unemployment and lost their jobs. And most importantly, the first bullet talks about lost wages and how folks think they're going to be able to handle the loss of income, the loss of their jobs. And if you look at the first slide, it looks sad and dismal. 64% of the people polled, and this was a national poll, because of lost wages due to the pandemic, are going to see a shortfall in paying their monthly bills. Some folks will see $500, some people will see $1,000. The next bullet talks about unemployment. When I first started writing this about a week ago, that number was about half of what it is right now. So what we tried to do was put together something that looked at 30 days in. Where are we? What does the law look like? What has changed on how we're doing business? What's changed with insurance, HR, and investment opportunities? So today we're going to talk about government action, what's been done, how it's impacted credit unions, charge-offs, collection activities. Kevin Fitzpatrick will talk about employee benefits. Seth Behrensweig is going to update us on the human resources side of it and recent developments in the CARES Act. Chris Staub will finish us off with investment opportunities. And after that, as I said, we'll move on to Q&A. So in the last 30 days, the US government, state and local governments have done a lot, some good, some bad, to deal with the pandemic. The most important piece of legislation, which everyone knows about and has heard about, is obviously the CARES Act. There are two areas of the CARES Act that I want to cover today that probably aren't being covered very much, but I think for the purpose of credit collections and folks who deal in my world, it kind of matters. The first is student loans, the second one is credit reporting. The student loan section is very easy to deal with. As far as the government is concerned, and the CARES Act dictates, collection of student loans is suspended. You don't need to get a letter, you don't need to speak with anyone, you don't need to do anything. If you're in the student loan servicing business, the answer is you're not collecting student loans at this point. If someone, and I like the law says, if someone wants to make a voluntary payment, they certainly can. But other than that, there's really not much that you can do in the student loan world right now, except if voluntary payments come through, then you can certainly take those payments, but there can be no request for payments. There can be no letters relating to payments. There's not a lot that you can do on the student loan side, and that's all the information that I think, or all the guidance that we have on that information. As far as credit reporting is concerned, and we've gotten a lot of questions on this, the first thing I want to talk about is the guidance that we've seen from the CFPB. And the information that we've seen from the CFPB is fairly basic, which is any disputes that come in with regard to credit reporting, it's the obligation of the credit unions to make sure that they continue to handle the disputes in a timely manner. What that means is, notwithstanding what's going on in the world, you still have to abide by requirements as to how quickly you need to respond to any issues relating to credit reporting and any disputes as to credit reporting. The CFP was also nice enough to let everyone know that they will be carrying out full enforcement activities during this event, and they will be looking into and investigating all lenders who don't handle disputes in a timely manner. Wasn't much on the guidance side, as much to let you know that they were certainly going to be enforcing, and they were certainly going to be looking into how quickly folks were dealing with disputes. On the credit reporting side in the CARES Act if you haven't heard, and even if you had, is amending the Fair Credit Reporting Act on how you report credit during this time. So the questions that we have is, how am I reporting credit this time? If someone pays or someone doesn't pay, am I changing? Am I doing something different? How do I do it? The basics on credit reporting are very simple. If you get a phone call, if you get a letter from a debtor, from a member, asking you to make an accommodation on whatever the reporting is, whatever the payments are. So if they want to stretch payments out, if they want to take their payments and defer them for a few months, whatever that information is, or whatever the accommodation is, once you reach that accommodation, that's the new normal on how you collect money from that person. Now, as far as credit reporting is concerned, you are obligated to report what was the normal, what was the reporting amount, what was the reporting information as of the day you made that accommodation. So basically, if someone was late or 30 days late or 60 days late, whatever the accommodation is, you would continue to report as that 60-day or 30-day or whatever late is. If that amount was current on the day you made that accommodation, notwithstanding someone is deferring for 90 days or 120 days, you are going to continue to report current. So the bottom line with this is that you will report the way you were reporting that the day you made the accommodation. Now, as far as accommodations are concerned, there is some guidance that these accommodations should be in writing. Hopefully, if you make these accommodations, they are in writing. It can be an email, and an email would be fine, but just having something in your notes could certainly lead to issues in the future. So the recommendation is that if you're going to make an accommodation, put it in writing, and then your credit reporting will reflect wherever you were at that time. Once the accommodation ends, then obviously you're going to continue reporting as you were. Now, as far as how long this continues for, the way the CARES Act reads is that from the 31st of January, the way you were reporting credit is the way you should be reporting credit during this event. So if you made an accommodation in February and someone was late, you should still be reporting it as the day of the accommodation. And this then goes for 120 days till the end, 120 days past the end of the event. So for January 31 until 120 days after this event, if you are making an accommodation for payment, then you have to make sure you are reporting to credit reporting as you were on the day you made the accommodation. And I'm sure people have questions about this afterwards. I'll be more than happy to answer those questions then. I'm going to turn it over to Milt now, let him talk a little bit about state actions. Just so you know, there's about 3 state actions listed here. We've compiled a bunch more only because this is changing on a daily basis.
Hello, everybody. Good afternoon. We're here to discuss the different court actions that are going on, mainly in the Mid-Atlantic, but also, as Gary alluded to, throughout the country. Primarily in the Mid-Atlantic region, DC has a moratorium on all collection activities. So what does that mean for us in the collection world? It means no lawsuits, no garnishments, no bank attachments, no liens, no levies, and more so, no calls or letters from any debt collectors, such as lawyers or collection agencies. So really, for all intents and purposes, collection activity in the District of Columbia has ceased for a period of 60 days until after this COVID-19 emergency is completed. In Maryland, there's also a moratorium. However, that moratorium is limited to evictions, foreclosures, and repossessions. The time limit for this moratorium is also 60 days after the ending of this COVID-19 emergency, whenever the governor deems to declare it over. The difference is that in Maryland, the courts are open and are taking new filings, unlike DC. However, most of the filings are limited to electronic filing jurisdictions. So what does that mean? That means filings in all counties except for Montgomery County, Prince George's, and Baltimore City are accepting new filings. For those other non-electronic jurisdictions, we basically are on hold until the courts reopen, which at this point is set for June 5th. Virginia, on the other hand, has taken a county by county approach. There's no statewide guidance on when the courts will open. Some courts will be opening as early as the end of this week. Some will be opening or have extended the emergency through the beginning of May. That's a moving target. So the only real consistency is that there is no consistency in Virginia. It's just going to be a hit and miss thing that we're going to have to figure out. In all three jurisdictions, really the courts are only operating on an emergency basis, which means no civil hearings other than emergency, injunctions, and criminal matters and family law matters, which the credit unions aren't involved in. The other question is that we've been getting a lot is in terms of garnishments and how they're being dealt with by the courts, not only in this region, but also throughout the country. And the answer is that the courts have taken a varied approach. Some are accepting new filings, but are putting those filings on hold. Others are not accepting new filings and are processing the ones that have been filed on a hearing by hearing basis if the member declares a exemption. So I think the best thing to do in terms of courts is to keep monitoring it. And as Gary had indicated, at the bottom of the slide, there is a URL with the Google Doc spreadsheet that gives a updated, detailed description of what's going on in each state. This spreadsheet gets updated daily. And so you have that as a resource, and I believe the URL is going to be included as a chat, so you all have that link. Gary, that's all I have. Throwing it back to you.
Thanks, Mel. So before I move on to current legislation and what's going on, I wanted to add one, well, I guess it falls in this category as well. I wanted to add one thing to what we were discussing on credit reporting. In March, there was a bill that hit the Senate that was called the Disaster Protection for Workers Credit Act. This would actually suspend all negative credit reporting for the next 4 months. At this point in time, that's a bill that has not been reported out of committee. It's not a bill that seems to have legs, but we're going to continue to monitor that. I'm sure if something like that makes it to the floor of the Senate and finds its way to the House, I'm not sure it'll get much further than there, but I don't think anyone foresees this bill going much further than committee. So I'm not that concerned about it, but it's good to keep on the horizon that it's out there, and it'll speak to the fourth slide when we get there. So currently there's two bills moving through the House and the Senate, HR 6379 and Senate 3565. Basically what these bills are, and we'll go through it a little bit more, are the House bill is a 1,400-page bill with 9 pages buried in the middle from the Banking Committee that talks about debt collection. There's a nice section on rent collection, which is also a bit frightening if you're a landlord. But the 9 pages that concern debt collectors and concern credit unions especially discuss, and I'll just go through bullets, discuss how they're going to refer to debt collectors. In this act, debt collectors will now be anyone who has debt. So basically original creditors would now be included in this redefinition of the Fair Debt Collection Practices Act. This bill as well places a moratorium on all consumer debt collection for the term of the emergency as defined by the president and 120 days thereafter. No action is permitted during this time, although letters may be sent, but those letters have to specifically say that no action will be taken, and the only thing that will be available is voluntary payments. In the event of a violation by anyone, original creditors, debt collectors, the violation is now 10x on the current statutory FDCPA, which means a violation is $10,000. There is some discussion about the Federal Reserve setting up a fund so that banks will be covered for their losses during this time. Since credit unions don't have access to the Federal Reserve, credit unions will not have the opportunity to take advantage of this fund if this fund actually exists. As far as the Senate bill is concerned, it mirrors the House bill. It's a standalone bill. It's not 1,400 pages, but that Senate bill, again, has not been reported out of committee, and it looks like it will probably die in committee. So in response to legislation and everything that we're seeing and what the states are doing about garnishment, what the counties are doing, what the federal government is considering doing, credit unions really need to rethink their approach to lending and collection. So a couple of recommendations are, beyond what's in place to date, credit unions really need to start thinking about their hardship policies and how they're dealing with their members. We've spoken with a few credit unions. Our firm represents, I think, 50 plus credit unions, and we've heard from a number of folks saying, we're adjusting our hardship policy. Let's talk about settlements a little bit more. Let's talk about extending the payment plans a little bit more. We haven't heard from everyone, but we are hearing from a number of our credit unions on this, and we're getting some good information. What we would recommend is really taking a look at this and how you're handling this. One of the bullet points here is on the stimulus. We've heard from a number of our clients asking us whether stimulus checks can be attached. Unfortunately, for folks who are getting stimulus checks, they can be attached. Our recommendation is to not attach them because of the optics that are associated with attaching those checks. There are some states, I think it was on Milt's list as well, but there are some states who are, and AGs who are talking about stopping the garnishment of these checks, but it's a state-by-state basis. There is no federal law on this. The last thing that I want to talk about is just post-pandemic, what we think about on how we handle credit collections. Obviously, because of the massive unemployment, we're going to see more bankruptcies. We're going to see more folks who are interested in payment plans. And how you deal with that is going to be an important issue. I understand we're not through the woods yet, but I think probably in the next 10 to 15 days, maybe 2 weeks, credit unions and everyone needs to start thinking about what policies they're going to be putting in place in dealing with their current creditors, what they're going to be doing as far as adding staff, whether that staff is collections, whether that staff is customer service, but starting to think about what the world is going to look like after this is over and dealing with their members and dealing with the folks around them. That's all I have. I'm going to turn it over to Kevin.
Well, thank you, Gary. I appreciate you putting this all together here this afternoon. Good afternoon, everyone. Gary asked me to speak for a few minutes on the status of the health insurance industry, give everyone a quick update. The good news is that the industry itself is very healthy. It's well capitalized, and they're in a good position to help small and mid-sized businesses weather the COVID-19 storm. For example, just last week, United Healthcare advanced over $2 billion to providers and hospitals who have been financially impacted by COVID-19. This makes a lot of sense. We've heard a lot about admissions to intensive care units for folks affected by the coronavirus, but providers have seen a precipitous drop in revenue from both routine and elective procedures being postponed. And the carriers are recognizing this and stepping in to help fill that void because they want to have a state of readiness with those providers once all of this was wrapped up. Other carriers like CareFirst, Blue Cross Blue Shield, obviously a market leader here in the Washington, D.C. area, they've partnered with the state of Maryland. They've actually established a 211 hotline for COVID-related questions. CareFirst is going to be triaging and coordinating care for all the individuals affected in the state of Maryland, and most likely expanding that into D.C. and Virginia on an as-needed basis. From a premium relief perspective, most of the major carriers have stepped up to the plate with premium relief. I'll reference Care First again. Care First is offering clients up to 60 days of premium relief for the months of April and May. That is probably going to be extended to June from what we're hearing at the executive level there. More to come on that. The typical range for most of the major insurance carriers is that 60 to 120 day mark. Many of the big carriers are doing it on a case-by-case basis, but we can tell you from what we've seen, they're being very liberal with not only the terms, but the terms of the repayment as well. In almost all cases, there is no late payment penalties. There is no interest paid on extending that debt. In addition, they've showed a tremendous amount of flexibility as it relates to eligibility. Folks who have been laid off and furloughed, or folks who have dropped below full-time hours, are being allowed to stay on the health insurance plan. Under normal circumstances, that would most likely be a COBRA situation, and you'd have to go through that process here. Once again, a lot of flexibility. Most carriers are running this right now all the way through the end of summer. Some a little shorter, some a little longer. You have to check with your carrier to find out the specifics. Talking about premium relief and PPP here for a minute, and maybe I'll just give everyone a very brief update on PPP. This is just a couple hours old. There appears to now be agreement in the halls of Congress on an extension or a replenishment of the PPP package. The new bill is going to be called PPP and Healthcare Enhancement Act. It's a $450 billion package with $310 billion of it going specifically towards PPP. Now, out of that 310, $125 billion we believe is going to be allocated towards what's being termed right now the unbanked, small micro businesses there who don't have a formal or much of a banking relationship. 125 billion is going to be allocated towards that. Also put into that category are going to be minority-owned businesses and businesses in rural areas. Again, targeted for 125 billion of relief. On top of that, an additional $50 billion, it would appear, is going to be allocated towards the EIDL loans, the Economic Industry Disaster loans. Again, targeted at the small business. We know there was some pushback in the first round of PPP where some large name companies were able to get $10+ million. Some even had to give it back. And looks like Congress is trying to put in pieces in place to prevent that from happening again. Now, in regards to premium relief strategy in PPP, it would seem like a no-brainer. Of course, I'm going to go ahead and take advantage of PPP, of premium relief from my health insurance carrier. But if I do that, in this example, for the months of April, May, or even into June, we know that PPP right now is requiring businesses to spend that money in an 8-week period. And if you're not spending it on either payroll or healthcare and other fixed cost related items, parts of that PPP loan may not be forgivable. So walk through that with your consultant, walk through that with your accounting firm, whether or not you end up taking advantage of short-term premium relief. The carriers are having some degree of recognition of this, and there may be an extension of their premium relief or the ability to switch deferral dates to a point in the future. Pay now with your PPP dollars, defer in the months of July, August, and September there to buy additional time. A couple of basic changes, and I'll end with this here. Excuse me. That insurance carriers have put into place almost across the board. Most carriers are waiving deductibles for waiving deductibles for COVID-19 related services. And that includes no co-payments and also no co-insurance. What we mean by co-insurance is if you have a 90-10 or an 80-20 split with your insurance carrier, they're not going to require you to come up with the 20% for COVID related services. It's going to be at the 100% level. And many carriers are also waiving prescription refill limits on maintenance medications. Why are they doing this? They're trying to keep folks at home from congregating, let's say, in lines at the pharmacy and having the ability to have larger quantities of prescriptions shipped to them. Not listed on this page, but we fielded a lot of questions on this in the last couple of weeks. If you're an organization that offers group disability insurance, short-term and long-term, how is that being covered under the new COVID-19 environment? For the most part, it's business as usual on that side of the house. Simply being quarantined voluntarily or mandatorily does not mean you're going to have a triggering mechanism for a short-term disability claim. There still has to be a medical reason behind it. Obviously, a diagnosis of COVID-19 certainly would be a triggering mechanism for it. And then, of course, that would mean a mandatory quarantine for you. Some carriers are looking at it a little different, but that synopsis probably encompasses what 90% of the short and long-term disability carriers are doing out there right now. And we'll end with this. capgroupfinancial.com #/COVID-19 is our resource website. Please feel free to stop in and visit. Lots of resources. Everything I just discussed is up there on the page. And that's all I have for everybody today. So I'm going to send it back over to Gary and Seth now.
Actually, Kevin, I'm going to send this over to Seth and let Seth take from here.
Good afternoon, everyone. I'm Seth Behrensweig, and I am the managing partner of Behrensweig Leonard. We're a business law firm here based in the DC metropolitan area. And we work with owners, companies, executives, and HR professionals to help them navigate through the legal issues such as are now being presented with this national crisis. In that regard, my role here today is to try to make some sense of the new laws and some strategies and how they apply from a human resource perspective. Employment and HR continues to be the lifeblood of companies, and it's crucial for companies to maintain their viability by understanding how to be able to manage their workforce issues during this historically unique and challenging time. And there have been a number of significant changes. I'll focus initially on the major changes from the United States Congress and how that applies to managing your workforce and how to handle those kinds of difficult issues. Starting with the first slide, we're going to be focusing on the emergency paid sick leave and expanded family medical leave. Certainly with the advent of the COVID crisis, Congress recognized that there needed to be immediate legislation to provide immediate relief for employees to be able to obtain expanded sick and family medical leave. And what the act provides is to have automatically up to 2 weeks of paid sick leave necessary based upon somebody's medical condition. But importantly and more broadly, it also provides an additional 10 weeks of emergency family leave on top of otherwise available extended family leave to be able to remain at home to care for either a family member who is suffering through the virus and or to care for a child whose school or otherwise daily provider is closed as a result of the crisis. And as a result of this, individuals are provided with this emergency family leave. We've had a number of questions from our clients as to whether or not, or the nature in which this provides any kind of an incentive for people to stay home, not working versus the status of whether they wanted to stay home but work from home. It's important to note that the way that the law is structured, perhaps inadvertently, there's essentially a medical disincentive for people to stay home to care for their family on an off work status, because the pay on a daily basis drops pretty significantly down to a daily rate of roughly $200. But if they can work remotely, and if they do have that kind of ability to do so, then they can be at home with their family while still staying on full paid leave. Another option, which is readily available in case of a financial emergency, which is being faced by a lot of employers, is the notion of dramatically expanded temporary furlough. What is happening in this situation is that employers are under a significant capital burden, and they're finding it very, very difficult to be able to continue to maintain a full staff. But by the same token, they don't want to lose their employees because they want to be able to come out on the other side of this crisis. So what Congress has done is they've provided for a new temporary furlough, whereby you can furlough your employees, and they are going to get what we essentially call a turbocharged unemployment insurance from the state-based employment commission. Because of an additional federal subsidy, they are now getting roughly close to 100% of their pay, which is very unusual because sometimes they would get closer to maybe roughly half of that, but they're going to get just about all their pay on a temporary furlough leave through the state-based employment commission. And then that way, the company can keep its capital preserved from an operating perspective. They can put someone on furlough, and then when things ease up and cash flow is eased, then they can retrieve people off of the temporary furlough and then bring them back as full-time employees. So the company has, from a human resources perspective, a number of different options that it has, and it's important for employers to be aware of that, because that's the whole purpose of why Congress provided that, to provide some flexibility so that companies can survive and then ultimately jobs can remain throughout this crisis. With respect to what you need to do in order to effectuate this, employers have to be prepared to document who's requesting leave, the dates of the leave, and as appropriate, documentation, supporting documentation from a healthcare provider. But as a practical matter, as we see often in the human resource world, you have to do it in a way that recognizes the sensitivities and realities of the situation. Currently, somebody may not be able to immediately get a doctor's note because they may be too sick to go to the doctor, or the doctor's office is closed. So even if the person wanted to get a doctor's note, they wouldn't be able to do so. So, you know, Gary earlier talked about making certain decisions based on optics, and I think that was a good point. I would caution employers to take this paperwork aspect from a discretionary standpoint and really make a decision on a case-by-case basis whether or not they want to temporarily defer the need to document leave based upon illness. They could always circle back and do it later. And as a practical matter, a lot of these closures are a matter of public policy. So if someone needs to be home to care for a child because the child is home from school, but the school is closed as a result of a public order from the state's governor, for example, that documentation will be sufficient in order to make sure that the employer is completely covered as they move forward through this crisis. One of the aspects of this, which of course is crucial to the legislation for surviving this as a practical matter and to take care of your employees, is the PPP, the Paycheck Protection Program. This has been in the news for either good or bad reasons, and really this was a situation where we had just many businesses throughout the nation just kind of dashing at the same time for the same goal line. And as a result, the money, which was technically supposed to be available to be applied for through the summer, was gone within a matter of days. So as was noted a few minutes ago, we're literally on the cusp of Congress triggering around another $300 billion into that program. Therefore, employers that were not able to get into the first round of PPP are going to be able to get in there on the next round, which could be available for you for as early as this Friday. And again, the purpose of this is for the protection of payroll. So there was a story out of New York, for example, where there was a restaurant where the owner was on CNBC saying that he was really happy that he got $5.5 million, but he's just going to hold on to it for a while and then he'll use it in a few months to use his startup capital. And unfortunately, I think he got himself into a False Claims Act situation potentially, because that's not what PPP is. It's for currently existing payroll. It's payroll protection. And if and when you get it, you have to apply it now for the next 8 weeks. And the way this is calculated is your average monthly payroll times 2.5, where you are supposed to take 75% of the money that comes in and lands into your operating account to cover payroll, and then 25% of that for rent and other related expenses such as utilities. So it has to be used in a certain manner. It's important to keep in mind from an HR and from an employment law standpoint that while this is something that's very powerful to help keep your staff available, of course, if you don't get PPP, you can put them on temporary furlough, and then they're going to be covered in an emergency standpoint by the state-based employment commission. If you do get PPP, then you can keep them on board even if they're not working, and you can keep them on the payroll. That's what Congress intended. It does not supplant the employer's ability to exercise appropriate discretion as to whether or not it wants to terminate an employee for inadequate performance. There's no specific special protection for that. Additionally, if you terminate an employee and your application, let's say, for example, is predicated on an average monthly payroll of, let's say, 50 employees, if because you terminated someone for cause, you're down to 49, you can replace that person at or at approximately the same rate of pay, and you don't forfeit your PPP. If you apply it appropriately and if you follow the rules, although you will sign promissory notes when you start, it will convert into a free grant. And then if used appropriately, you do not have to pay the money back, which of course is something that is just a tremendous help to the credit of the Congress and the President. We've covered the groundbreaking legislation and some of the things that it applies directly with respect to handling and managing your company from a human resources standpoint based upon federal law. When you look at things based upon state law, there are aspects that flow into this that are relevant as well. Just as a very quick recap, as many of you may know, Maryland and the District of Columbia have really kind of been at the forefront in this region with regard to what are known as the Employment Human Rights Acts, based upon giving individuals certain protections in the course of their employment and giving them an opportunity to file certain claims against the employer, which we see all the time as we defend employers in the DC region. But something that happened very quietly during this crisis, which is just really groundbreaking, is that the Commonwealth of Virginia enacted new legislation, which is going to be completely groundbreaking, which is going to be a complete game changer in Virginia for companies that either are based in Virginia or work with other companies that are located in Virginia. And in a quick nutshell, there's the so-called Virginia Values Act, which now, effective July 1, blows open the door to allow people for the first time in Virginia to assert broad civil rights claims against their employers and to be able to have jurisdiction to bring those claims here in state courts in Virginia, which is very significant for at least two reasons. One, this is a whole new panoply of laws that never existed anybody in Virginia ever before, which is a new thing that employers have to be aware of. And two, this is going to be the first time that these cases can be brought directly in state courts. And Virginia state courts are very difficult to file motions for summary judgment to get rid of cases, whereas that's a much quicker play in federal court. So this is a groundbreaking development in Virginia. There's also another groundbreaking development here with regard to worker misclassification legislation. It's a very typical error sometimes where companies mislabel or mischaracterize in good faith whether someone is actually an employee or an independent contractor. In the past in Virginia, there really wasn't much of a consequence to that. There are new harsh penalties and a new cause of action in Virginia for misclassified workers, which provides for damages, penalties, negations of non-compete clauses, just a whole array of different things. So these are all going to be effective July 1. And the bottom line is that you need to be aware of that if you are working in the DC region, either in or touching the Commonwealth of Virginia, because these are major changes that are going to be coming into effect in just a couple of weeks. So that's an overview from a federal and from a state law perspective. And now I'm happy to turn it over to Chris.
Thanks, Seth. Appreciate it. And just as an FYI, my name is Chris Staub of the Capital Group. I'm the managing partner and chief investment officer of the firm, partners with Kevin Fitzpatrick on the benefits side. Today, we wanted to go through kind of something off the wall, so not anything that we had discussed thus far with the coronavirus, but just the opportunity that we feel like exists right now. And what we do for credit unions is we work with credit unions on what's called pre-funded benefit plans. And it's basically an investment allocation that you're able to do and invest in into non-traditional assets. And right now, where the market is currently, we feel like there's a big opportunity, and there's an opportunity for our credit union clients to be able to put dollars to work and take advantage of Right now, if you look at it on a daily basis, the market's down about another 5% yesterday and today. So we're probably down about 20% from top to bottom. And we feel like that's an opportunity right now for clients. There's a lot of credit unions that are uncertain about the current times, but if they do have cash that they would want to put to work, now is a very good time. And this slide here just kind of talks about timing is everything. And what we talk about with clients is order of returns. When you get into the market and the appreciation that you could see based upon a depressed market could drastically improve our typical returns that we talk to clients about in the 5 to 6% range, where we could actually look at a 3-year return in the 7 to 8% range because where the market is currently. So we feel like right now there's a very, very good opportunity. And although we talk to a lot of clients about this time being different, it typically is not different than what we've seen in the past. And this slide just shows previous pandemics that we've seen all the way back to the 2008, 2009 when the swine flu came, and then SARS back in 2003. And we always have recovered. So we don't feel like this is going to be different this time where the market's going to continue to be depressed. We feel like there's good buying opportunities currently for everybody to invest in. This is actually a slide that just shows a chart based upon January of 2019 and where we are today. And in actuality, people don't realize that we're actually right where we were middle of the year last year. And last year, around July timeframe, people were pretty comfortable with where the market was and where their portfolios were. So we have seen a down pressure, obviously, on the market, and we feel like we've seen a bottom. A lot of people are talking about us retesting the lows. I think that would be probably a pretty good drop from where we are here currently. So we don't feel like we're going to retest the lows in the market, but we feel like that's still a good opportunity for a lot of clients to take advantage of currently right now. Just a little bit of an overview of pre-funded benefits and why investing in uncertain times maybe makes sense. Obviously, with interest rates declining as much as they have in the short term, a lot of permissible portfolio assets are going to continue to decline in general yield for the credit unions. So we feel like right now, even though this slide is showing in the last 5 years, decreases from 3.1 to about 2.9% in yields of the portfolio, we've been seeing a lot of our clients in the 2% or under range with their permissible assets in the portfolio. So with lower interest rates and possible advantages that can be or opportunities that can be taken advantage of in the current market downturn, we feel like now is a very good time for clients, both of our institutional clients with credit unions as well as our retail clients, to take advantage of some buying opportunities here currently. One of the other things that we just want to make sure that people understand is the statute that does allow you. And back in 2003, NCUA actually amended a regulation that allows credit unions to take part of their permissible portfolio and invest it in impermissible assets. And the impermissible assets could range from stocks, bonds, real estate, hedge funds, absolute return. There's a bunch of different strategies that can be used. They typically are monitored by the regulators, and typically our regulators wants to see you do no more than 25% of your net worth into the impermissible side of the asset pool. But we feel like right now the opportunity that exists, and this is something that was talked about a lot leading up to the 2008 financial crisis, and then a lot of people got very reluctant to do it since then. But we feel like this is a short-term down market that we're going to see here, and that there's a very good opportunity that does exist for clients. Some of the benefits, so the whole idea of pre-funded benefit, what this means is that you can take assets that will produce a yield or a return to help you pay for your benefits. And those benefits may include employee group health care, 401k matching contributions, your other ancillary coverages, dental, and defined benefit pension plans. A lot of times what we see is that credit unions have a very rich benefit package because they need to attract good people to their organization. And the cost of those benefits, even though Kevin loves what he does, he hates going out to credit unions and delivering 10, 15, sometimes 20% increases on the health insurance side. So we're trying to find creative ways for our clients to be able to invest their dollars in the pre-funded benefit account to to pay for these benefits. Current market conditions make it a very good time to invest. The NCUA backs this and allows you to do this, and you just want to make sure that you are documenting things that you're investing in, documenting the different types of investments and the different due diligence that you're going through as an investment committee. And we feel like this is just a very, very good time to invest in non-traditional assets at some very good prices as we go through.
All right, thanks, Chris. I appreciate it. Thanks for the information. I want to thank everybody for attending today. If you have any questions, please, you can email me, you can email any of the speakers today. All of that information is part of the materials. I just want to again thank everyone. Please be well, be safe, and hopefully we'll talk all again soon. Thank you.